Welcome back to Finance for Firefighters. Today we're going to talk about S&P 500 index funds. If you want one of the most simple long-term wealth vehicles to build wealth for your family, it's in the S&P 500 index. It's a simple, no hype, consistent wealth building vehicle that you can use over decades. By the end of this episode, you'll know what the S&P 500 index is, some different ways of getting into it and using it for yourselves, and the way of using this to build wealth for yourself over time. Most firefighters and most people overcomplicate investing. We're either chasing some sort of stock tip, we're listening to advice from other people, we're coming up with a strategy that makes the most sense to us at the time, we're getting in and out of the market, we're trying to time the market, we're doing different things like that. When you're investing in that kind of sense, you're gambling that way. But if you're doing it to the S&P 500 index fund, it's going to outpace that in so many ways, and we'll get into it. The S&P 500 quietly beats most professional investors. What is the S&P 500? The S&P 500, or Standard & Poor's 500, are the 500 biggest companies in the United States. Companies that you're very familiar with: Amazon, Costco, Apple, Johnson & Johnson, different companies like this. And you invest into the S&P 500, if the US economy grows, your money grows. Why do people like investing in the S&P 500? Well, there are several reasons for this. It's simple, it's diversified, it's low cost, and as the US economy grows, it grows. So the historical length of it existing is over 100 years, and its rate of return on average over that whole period of time is anywhere from 7 to 10%. So now that we know what the S&P 500 is, let's talk about what an S&P 500 index fund is. Well, if I wanted to invest in all 500 of those individual companies, I'd have to buy a stock in each company, right? And many of those stocks cost more than $1. So if I was going to buy $1 of each company, I wouldn't be able to do it because the stocks are above that. So to be able to invest in every single one of those companies, I'd have to put in thousands and thousands of dollars just to be able to get into it. The index fund is basically a fund that invests among all those different companies based on little percentages it splits, and it's constantly changing, but the weight of each company would not be 1 out of 500. It would be higher percentages for companies that are doing better. So right now, Apple or Microsoft is going to have a higher percentage than maybe a smaller company that's kind of on its way down out of the S&P 500. So the index fund allows you to buy a ETF or an index fund into the S&P 500 for anywhere from $300, $400, $500, $600, and now you have one tiny piece of each one of those companies based on that index fund. Let's go through a 5-step action plan on how to invest in the S&P 500. Number 1, pick your S&P 500 index fund. Here's some ETF examples that we can look at. VOOSPY. If you go into Google and you just type in top S&P 500 index funds, they'll give you a breakdown of the different ones that are available. Each one of those has a small fee associated with it. So if I buy $500 worth of VOO, for example, if that's what the cost of that ETF is, 0.01% of that particular one is built into the cost of the actual ETF itself. So I'm not having to buy that and then pay somebody else on the side. It's already built into the cost of it. So mutual fund examples like SWPPX or VFIAX are examples of mutual funds that you can get into the S&P 500 with. The differences between that and an ETF is that you can buy fractional amounts of the mutual funds. For VOO, for example, I'd have to buy one full stock of VOO of that index fund or of that ETF. But for VFIAX, I could buy $500 worth of it. So maybe it'll give me 1.03 or something like that. So the differences are that the mutual funds are settled at the end of the day, and the stocks or ETFs you're able to do basically right away. I put an idea of what I want to pay for that, or I'm going to buy it at what the current price is, and I'll do it instantaneously. Versus a mutual fund ends up getting settled at the end of the day. The main point here is that all of these different ones track the S&P 500, and they have different percentages built into the S&P 500. So they should be pretty comparable on their return. The difference for them would be possibly their fee schedules or how that money is split up. Number 2, automate your monthly amounts that you are investing into those brokerage accounts. So your job and your life is busy, and it's very difficult to be disciplined and to be consistent to purchase these things. So determine whatever that investment is that you're going to be doing per paycheck or per month, and just have it automatically set up to purchase, either to transfer that money in there from your bank account and to purchase things, all of these things through your brokerage account automatically, so you don't have to think about it, and you're consistently investing over a long period of time. Number 3, understand boring but powerful returns. So the S&P 500 historically has had 7 to 10% returns on it. There are times when the economy crashes, the economy dips, and all of that kind of stuff. But over historically, it always recovers. So if you're not so concerned about trying to buy the low, but you're just consistently buying it, there'll be times you buy it a little more expensive. There'll be times when you buy it at a discount. But if you are buying and you're keeping it for longer periods of time, you're going to recover any of those losses that you make during that time. Let's take an example of the power of investing. Okay. If I invested $500 a month from 25 to the age of 55, I would have invested about $180,000 over that 30-year period of my career. With the compounding interest and the returns that you're historically getting from the S&P 500, you're going to be getting anywhere from $550 to over $700,000 in return from what those investments are going to grow to. Number 4, what not to do. Don't stop investing during market dips. Don't follow the advice of folks around the firehouse. Don't pull your money out when things are going up or things are going down. Just consistently put the money in consistently over that time and let it grow. Number 5, how does the S&P 500 fit into your bigger plan? You can invest in the S&P 500 through your 457. You can do it through any Roth IRAs that you folks have, through brokerage accounts. If you, as long as those other retirement accounts allow you to self-manage things, you can invest in the S&P 500. If you're doing a target-based investment through those retirement accounts, chances are that there's going to be a significant portion of that money invested into the S&P 500, especially at the younger years of your career. You don't need to be brilliant, you just need to be consistent. So the S&P 500 indexes and being invested in it removes guessing, it removes market timing, it removes stress. Think of it like the version of somebody who just shows up consistently to work every time, shows up consistently to training every time. The person who does that is going to be a valued asset to your department, a valued asset, a valued member of your crew. Let's go through some common questions. Isn't this risky? Short term, yes, it is risky, but long term, it's proven to be one of the most powerful, simple wealth building tools. What if the US collapses? Well, investments aren't going to be your biggest concern. Survival is going to be your biggest concern. Do I need to pick multiple S&P 500 index funds? The short answer is no. Pick one that's right for you and just stick with that. Can I lose money? In the short term, yes, but in the long term, very, very unlikely. That 7 to 10% rate of return has been historically the same over 100 years. The S&P 500 is one of the simplest, most long-term proven ways of building wealth. Keep it simple, keep it boring, and build wealth with that. Download the S&P 500 quick guide in the description below. Thanks for joining me on Finance for Firefighters. Same as always, thumbs up if you like it. Comments below. Hope you guys have a good shift. I'll see you in the next one.